Amit Khurana, Head of Equities at Dolat Capital, joining us this morning. Amit, thank you so much for speaking with us. Now, on balance, the corporate results seem better than expected. That's because you've had the last few quarters preceding that with large disappointments. Would that be the consensus that you're seeing as well?
Yeah, thanks for inviting me. Absolutely, I think that's on the dot, and I think I was running through the flashes that were being shown. I think absolutely on the dot. Our numbers were largely on track. Our estimates are absolutely on the dot, in the sense that we are also expecting 1166 for EPS for Nifty 26 numbers. I think the larger narrative continues to be that this market has pockets wherein you can consider going overweight, and this market has enough challenges for one to keep a little bit on the cautious side. Q4 better than Q3. And just to put it in context, that Q1 and Q2 also have a very favorable base impact. Remember, Q1 last year was probably one of the worst quarters that we saw. And hopefully that should carry us through some tailwinds for Q1. And then hopefully if it extends, Q2 should also be a little bit better. So some tailwinds on the positive side, which will carry us through. But of course, there are challenges that one needs to be very well aware of, but largely in line.
Amit, so what stood out in the quarter? So on aggregate, good morning, of course, and thanks for joining in. On aggregate, the numbers are in line, but surely there have been some big or some key positive surprises maybe relative to your estimates, and some maybe slightly negative surprises as well, either in delivery or in commentary. What was that list like?
I think cement was clearly a positive surprise for us. While we did gather evidence wherein the pricing was trending better, but I think the operating leverage that some of the companies have reported and the way they are guiding it even for the next quarter or two seems to be far better than what we were expecting. So that's been one upgrade that we have made from neutral to positive stance of the sector. So that was one. Second, I think largely the staple companies I thought should have guided better. They seem to be qualitatively on the relatively better wicket. That's what one can read between the commentary and broader numbers. But I think the volume uptake is still something which is a bit of a mystery to me. It's not really showing the trajectory that I would have expected to sort of at least see by now. But maybe give it another quarter or two. Hopefully, we should be on track for that. So those are the two aspects which came out. Big disappointments, nothing really. I don't think we had a very significant big disappointment in terms of any big misses here or there. Because I think that largely the narratives are well captured. After the H1 FY25 not being up to the market, so the cuts had already taken all those disappointments into stride. So the larger case was, can we go back to worse, or will we just hold on to the space? And I think the end of the earnings season, it looks like we've held on to the base pretty well. And with most of the tailwinds now likely to aid earnings trajectory better, I think the sentiment sort of stays there.
Okay, interesting word on cement though, because one would have thought that this monsoon season would mean that the fervor for cement, if any, would cool off a little bit. But here you are telling me that their operational numbers look better and their guidance for the next 2 quarters looks okay as well, and which is why you have upgraded it. Would you believe the sector will tide through the weak monsoon quarter typically as well?
Yeah, I think there's a lot of cases one can build around it, but this is a seasonal phenomenon. I think the more important part is, even though the volumes take a little bit of a hit here and there because construction activity tends to slow down, but the operating profitability tends to be a far more bigger driver of sentiment. So I think that's one aspect. And second, very important is last year was a very poor first quarter, so you can't go worse than that. So market always looks at relative earnings trajectory. So last year was a disaster, and this year, even if it turns out to be marginally better, the sentiment turns around for the better, and that essentially leads to the re-rating. And that re-rating can just be disproportionately higher than what one would logically make out to be, which is exactly what is happening with the sector now.
Amit, what are your top re-rating candidates, and would some of them now exist in the BFSI space, or would it be quite the reverse, considering you're going to see now rate cuts? It's pretty much a consensus that rate cuts are coming in. Some margins will be hit there.
Well, yes, that's been one of the big concerns we've also had. I think market seems to be too concerned about NIPS, which we will not disagree with. But I think some of the franchises have really got into very attractive zones. So we continue to back up private sector banks over PSUs. PSUs was a trade for FY24 and 25, largely because of the credit cost reversal and write backs, which aided earnings. But having said that, I think even today, the ability of the PSUs to sustain NIMs is relatively more challenged, is what we feel. And also, while we are not building in a very major deterioration of the credit book, we still believe that the risks lie on the PSU side more versus the private sector side. So I would probably take overweight positions on private sector banks. Of course, there has been a lot of buzz around the street on the NBFCs and some of the other related lenders. In that sense, we like more on the gold finances side and the affordable housing than the traditional lenders against let's say CVs. We're not playing that cycle as of now. So banks overweight on private sector, and we prefer the gold lenders per se in that order.
So some of your favorites there on the screen. When you're saying gold lenders, a Muthoot, Manappuram, after all of the back and forth on what the regulatory headwinds look like, which ones are you liking there?
So we prefer Muthoot very clearly there. That's one of the larger franchises, and they're holding on to their growth numbers pretty well. And I think RBI will remain cognizant of the fact that the implications of any regulatory changes can lead to a trigger wherein the borrowers might move towards the unorganized, which is not the intended direction by the regulator. So I think that's the basis for which we believe that the regulations will take care of all those aspects and possibly not be too harsh.
You know, in terms of autos, Amit, I'm wondering how you're looking at autos. If I look at it from the numbers lens or the results lens, largely a disappointment on the passenger vehicles, I would say so-so, a 50-50 on some of the two-wheelers. Do you see a base case here for improvement here on for the financial year?
I would probably play the two-wheelers more so. Four-wheelers, I think the big challenge continues to be the threat from the EVs. That's one. And somewhere the new launches are just not working out to the way one would expect it. So two-wheelers has been one of our favorites since the last 2 quarters or so. And that continues to be the preferred one. There's been a lot of base effect talk on the CV cycle as well, but the evidence does not seem to support that hypothesis, at least in our minds. So we continue to play more on the two-wheeler side. Interestingly, some of the auto anchors are now looking more interesting, having corrected very materially. But I guess we need more evidence to back up that hypothesis and probably take a look at that. So as of now, only two-wheelers is what we would prefer to take.
Got it. Amit, where is it that you've changed your opinion for the worse? Where is it that you might have been constructive, but either based on the numbers that have come out or based on the commentary that has come out, or maybe valuations, either of the three, right? Where is it that you've changed your stance on the other side?
You're trying to make me as bearish as you can.
He's not feeling bearish.
So within this bullish mood, is there something that he's not constructive on? Let's try and get that.
Well, I think this market is actually not letting you go full bullish. Let me just put that in perspective. We wrote that as clear as we could be in the note itself. That 10% higher on the Nifty, you will tend to be saying, okay, we're expensive, so let's sell some positions and let's go cash. And 10% lower, it becomes a long period average driven market. So it's a market which is not going to go anywhere over the next quarter or two. And this is something that has been our view for the last 6 months, that CY25 is going to be a year of consolidation. It is going to be a year of bottoms up, investing. It is going to be a year of doing some real thorough work on the models that will outperform beyond CY25. And that, I think, continues to play out beautifully over the last so many months. It's giving you enough opportunities to make your work. For example, we've been overweight 3 quarters back. And I thought at that time we were probably a little too early because that was not the consensus. So while one can make a case that what is not looking too good and what is looking expensive, there are individual stocks. For example, hotels. Structurally, the cycle is playing out beautifully. We've been on the other side of the fence saying valuations are too stretched. 25, 27 times EV/EBITDA multiples can't justify, but they've been delivering exceedingly well. And even though there have been enough cases to build that the base is not favorable, pricing can have its own limitations, but the stocks continue to sustain at least these valuations for the last 4 quarters. Similarly, while we've been very bullish on Alcho, there can be a case to make that some of the multiples are now extremely elevated, which we recognize. So the upsides seem limited there. But for me to say that, are they sell candidates simply for a tactical trade, I would probably not do that. I think we're very clearly playing consumption as a structural theme when we upgraded it last year, and our take was 2 to 3 years. And that continues as a hypothesis. So very difficult to make a very extreme case wherein anything looks too expensive. I think that froth is out over the last 6 months. If that was, we were sitting way back in September, you could build literally an n number of cases. Of course, defense something that we don't formally cover, but some of those stocks are extremely rich in valuation. So one could probably
Ask
make
you
a case
about
for.
defense, Amit, because extremely overvalued, some would say, but did their numbers actually deliver?
Yeah, precisely. So, and by the way, they've corrected. Some of those franchises have corrected 40, 50%. So the froth is out. So you could say that relative level, they are cheaper, but then historic level, may not look that cheap. So one can make both the cases in this market, and therefore it's extremely bottoms up that we are looking at. We're looking at within same sector, for example, staples. For example, we like BKG. It went through its own challenges. We like Britannia because it's gone through the raw material inflation cycle pretty well. But the same case cannot be made for other staples that we cover. So it's extremely bottoms up hypothesis that we are running for the next 6 months. And so that's where we are.
So much pleasure speaking with you. That was a view coming in from Dolat on the quarter going by. And I would say we're not out of the woods yet. It needs to be a wait and watch. But yes, definitely Amit Khurana's view that Q4 was better than expected.